Let's connect with Mr. Kirit Parikh. He is oil and gas expert to talk about the new Kirit Parikh committee recommendations. Mr. Parikh, good morning. Thank you for joining us. You have suggested trade parity pricing despite such strong demands of export parity pricing. What is the thinking behind this recommendation?
No, I have been arguing, export parity price is really the right thing to do in many ways. But we have taken a view on a rather pragmatic basis, because the way we calculated the export parity price, it comes very close to trade parity price. Actually, the difference is only 108 rupees out of a price of 46,000 rupees per kiloliter. Given that the price difference was so small, we felt that given the fact also that the government has decided to liberalize diesel price, there is no point in upsetting or the calculations and measures now, but instead to go directly for maybe do some reforms in the diesel price. And this trade parity price is almost the same as export parity price. As I said, only 0.25% or less is the difference between the two.
Mr. Parikh, your recommendations are pretty bold and brave, but will these actually be acceptable as well to, political masters, especially with elections just about 6 months away?
Yeah, no, I think, the political masters would decide their own, will take their own decision based on their understanding of the politics. But as an expert, I feel we should give the advice that we think is right. And if every expert is going to give the advice of what he thinks the politicians will want to hear, then really there will be no progress in the country. You can't just give the advice that is toned down to such an extent that it is all pragmatic and politically feasible. Then you will be able to do only what seems to be, what you perceive to be politically feasible. Maybe what I perceive to be politically feasible may be much less than what the politicians actually might be able to do. So first of all, I think we should, as experts, as outsiders, must give the best advice that we think is possible, and then leave it to the politicians to decide what is politically feasible. Secondly, I think what one has to also recognize is that not doing things like this has a huge cost, not only in the long run but also in the short run. A study that we have done at the IRADE Integrated Research and Action for Development, this is our small non-governmental, non-profit research institute, we had done, which had shown clearly that not increasing diesel price would lead to higher inflation and lower economic growth 2 years down the line. And so it really doesn't make sense. And even in the short run today, I feel that raising diesel price would have a smaller impact, adverse impact, and much larger positive impact. If your under-recoveries keep on going up, if the fiscal deficit remains high, if the country's rating goes down, all these could have a very significant adverse impact even in the short run on the economy. And I think this other question of inflation, the current inflation is largely food inflation driven. And if the onion price goes up from 20 rupees to 80 or 100 rupees, it is not because the cost of onions have gone up. Even if cost of onion maybe producing is 15 rupees, and if you add to that even 2 or 3 rupees for transportation cost, it will be 18 rupees. And still you are selling at 80 rupees because 80 rupees is the price at which the available onion will be purchased by the market. And that will remain the same whether the transport cost is 3 rupees or 5 rupees. So I believe that even raising diesel price would have a small impact on inflation in the current situation.
Mr. Parikh, why have you exempted GAIL from the subsidy burden, and what about the upstream share? How are your recommendations now really addressing the whole issue of ad hoc subsidy mechanism?
No, I think one thing is GAIL, we have kept it only up to the level to which it gets some production and it has some gains out of the APM gas and so on. But we have then said, other than that, GAIL should not be asked. So it's a small reduction in GAIL's contribution. and a limit on what it will be contributing. As far as the upstream is concerned, say ONGC and OIL, what has happened in the past is that the government would decide on a fairly on an ad hoc principle how much they want the ONGC to contribute. And this has created a lot of uncertainty, and it creates an uncertainty in the valuation of ONGC as well. And over the years it has left little surplus for ONGC to invest and explore further. And also because there is a lot of uncertainty, it is also able to do less of an investment and exploration. Whereas we argued that it would be much more sensible to have a formula-linked price, and a price or a contribution of ONGC which should be such that it is some rationality and a level playing field with other upstream producers. That's why we said follow the same principle as an NELP, the profit sharing mechanism. But instead of profit sharing, we said a revenue sharing, which is what Rangarajan committee is also recommended for NELP rounds now. So a revenue sharing mechanism based on the NELP formula is what we have suggested. We have tweaked it slightly at the lower end of the price and the upper end of the price, but it is more or less between $80 and $120 of the crude price. It is following essentially the NELP price.